You're watching Investment 360. With us from Cape Town now is Kokkie Kooyman, head of Sanlam Investment Management Global. He's talking to us about the Global Financial Fund. That's the Sanlam Global Financial Fund. And Kokkie's up for the Investment Week Fund Manager of the Year Award that's taking place in London next week. So firstly, Kokkie, I assume we must wish you good luck for that awards ceremony, and hopefully you're going to bring some good news back here to South Africa for us. Just looking at the Sanlam Global Financial Fund, to put it into perspective for our viewers, if you had invested $1,000 in 1999 in this particular fund, you would be sitting close to $6,000 right now. Whereas if you look at your benchmark, the MSCI index, you'd invested the same $1,000, you'd only be sitting with just under $1,400. So outperforming your benchmark significantly. I've got David Shapiro in studio, and Kokkie, he is invested in your fund, so I'm going to let him do a lot of the questioning tonight.
Aggressive questioning.
Exactly, but very quickly, if we can just start in terms of the bias that you've got in terms of geography right now.
Yeah, we've got nothing in Europe except Deutsche Bank, and that's really because, you know, we can't see how it plays out anything but badly. The whole Greece, Portugal, possibly Spain scenario. We reduced India and China quite a bit. In China, in fact, we've only got one bank and it's only 1%. India, with hindsight, we didn't reduce enough because of higher inflation and higher interest rates there. But India, it's about 15% now. And then Indonesia has done very well for us. There's about 12% in Indonesia, about 6% in Brazil. And then the US is also about 15%. And what we did after the earthquake, we increased Japan quite a bit. We went across back to Tokyo again. I think it's my 6th time there. And for the first time, I must say, I was actually impressed with Japan in terms of what's happening. It looks like the Japanese banks are clean, and I think everybody's too negative on the earthquake. In fact, it's funny enough, it's a positive event.
Just to let you know, I'm invested in Kokkie's best ideas and his financial fund.
Well, you certainly got the thumbs up from David.
And that was
Kokkie.
against his judgment. He said, don't believe or don't listen to the salesman. Okay, but he's done brilliantly and highly respected. Kokkie, the question that I want to ask is about American banks. You know, you're 15% there. Can you share with us your favorite banks there and why?
Yeah.
You know, do you think they're over the worst?
Yeah. I think it's been cleaned up to a large extent, and the banks have been forced to recapitalize. In fact, Bank of America, one of the largest holdings we have in America, is not allowed to pay dividends yet by the Fed because they're not quite happy yet with their capital position. So the Fed has played a very active role cleaning up the banking system. It's been over-regulated, I think, but okay, that comes with the current circumstances. So at the moment in the States, we are, and Bank of America is our largest holding because it's just awfully cheap now. It's a 30% discount to a fairly cleaned up book, except for the mortgages, and even there they took a $8 billion settlement charge there. So and then the others, which we have smaller positions, we bought recently as the US banks came down. JP Morgan, US Bank, or two of the best banks. And interesting, a very small little financial services player, much like our African bank, World Acceptance Corp. It's done amazingly well. It did about 90% for us last year, whereas the banks were actually flat. So, but to answer the question, I think the US banks are a lot safer, but it mainly now depends on the US economy, on which we're not that positive.
Two banks that are always in the highlight, MasterCard and Visa. Do you have views on that one?
No.
Particularly against the legislation they're bringing in now. Sorry, I think you struggled to hear me there.
Yeah, no, the legislation, and that's been for most developed market banks and credit card issuers. There's been a lot of legislation, especially the Durban amendment, and that's nothing to do with Durban here in South Africa, which is very onerous on banks and is actually quite bad on the banks, but it actually favors the credit card issuers. But the credit card issuers have had huge bad debts, which they seem to be over. So they are actually better positioned, but for us, they're just too expensive at the moment.
Just looking at Indonesia and the fact that you've got 12% exposure there, I see a stock that you throw forward to is BFI Finance.
Yeah.
Kokkie, can you speak specifically to BFI Finance for us?
Yeah, look, the one advantage we have is, well, two. The one is we're fairly small. The fund is $200 million odd, so it allows us to buy lots of nice, exciting opportunities. And the second one is global. So you just got to find a few opportunities in each country. And BFI was one of them with a company that's very similar to it, Adira. They finance second-hand motor vehicles. And effectively, it's like an African bank again. But instead of lending money directly to people, they actually lend via the sale of motor vehicles at the same type of interest rate, well, lower than African Bank or Capitec, and with interesting, very low bad debts. And this company has grown quite well for a long time, but because it was small, it was just ignored. And we've been invested there since 2005. And it paid a fairly good dividend, about 10% each year, and gradually did better. Now suddenly, beginning of last year, it's been recognized and the share price has started exploding. It's up, I think it's about 220% in 1.5 years, and it's still on a P of 7. So, what more do you want?
I can see, David, why you're investing in Kokkie's fund. You wouldn't put money anywhere else.
No doubt about that. We can't let Kokkie go without asking about local banks.
Of course, Kokkie, although we are talking about the Sanlam Global Financial Fund, you mentioned there the likes of Able and Capitec being very similar to BFI.
Yeah, look, we have been invested in South African banks. It's a global fund. In 2003, in fact, we had, I think, 15% exposure to our banks because they were just then way too cheap. And at times, we've been invested in African Bank when African Bank at one stage was quite cheap. We've long held a position in Sasfin. Yeah, Sasfin was also for a while very, very cheap, and it's actually still cheap. But at the moment, it's just liquidity is a bit of a problem. But South African banks, it's very simple, in that the loan growth here is still very anemic and the valuation's too high. If I show you an example, Standard Bank is trading on, let's say, 1.6 times price to net asset value. So it's a 60% premium to its net asset value, whereas Bank of America is trading at a 30% discount. The Japanese banks are trading at 30% discounts. And if you adjust for inflation, the return on capital of all these banks is almost the same. So, Standard Bank, when we do an international comparison, our banks are just a bit too expensive.
Is this a quid pro quo relationship? Kokkie invests in Sasfin, you invest in the Sanlam Global Financial, and Kokkie's best ideas. I'm worried, gentlemen. Should I be launching an investigation on this discussion?
He was in Sasfin a long time before I joined.
Kokkie, perhaps just one last statement. I don't know why for a moment I thought Global excluded South Africa. That was a very, very blunt statement from my perspective. But looking at Capitec, what are your thoughts on Capitec? I mean, this bank has done so phenomenally well.
Yeah, no, it's done, as you say, exceptionally well. It's actually... It's what they call destructive capitalism. It destroys its opposition because it's reinvented the wheel at the lower end of the market and is really challenging the bigger guys, and they're starting to react now. So, I mean, I think there are two risks in Capitec. The one is simply that the bigger guys start reacting, and remember Sambo, remember Unifer. I think the big banks won't win in that lower income space because they don't understand it, but they will destabilize the market. They'll grow loans aggressively, they'll reduce the margins, the profitability. So for a while, players like Capitec could suffer. Secondly, Capitec are going into 4-year loans, and it's been much written about, but it's a different dynamic. And I think the risk is they could be going through a learning curve. And on a 4-year loan, your economic circumstances play a much bigger role than 1 month. 1 month, the risk is you're wrong for 1 month. And, it's come back a bit. It was very expensive. It's come back a bit, but it's still marginally expensive. But, if you look at the quality of management and the track record so far, on a longer term, I'd hold it. But shorter term, even Standard Bank is is cheaper. By the way, even Standard Bank. I like Standard Bank. I think Jack and Maria and the guys will get it right again. But so Standard Bank is expensive. Capitec is very expensive compared to international players.